Well, hello and welcome back to Principles of Accounting 2. I am your host, Dr. B. We have made it all the way to week 5, which is yay, fantastic. We made it halfway through. All right, yay, halfway. Okay, so let's quick housekeeping notes and then we'll jump into today's presentation on cost, volume, profit analysis, and contribution margin. So I want to quickly highlight where we are. I am in the process of grading from the previous week. Hope to have everything graded and in by Friday. Actually, it'll probably be in by tomorrow, is my guess, by tomorrow evening. Let's see. We're in week 5. We're going to be going over cost, volume, profit analysis, and contribution margin, break even, all of that good stuff, which is what week 5 is all about. I want to draw to your attention what we have going on this week. This week, very busy week, very similar to how busy week 3 was. In week 5, we have your 10K discussion is on the statement of cash flows for your 10K project. The assignments that you have for week 5 include a homework assignment based on cost, volume, profit analysis, and contribution margin using the make or buy decision. And then we'll also have, oh my, of course, your weekly report, but very important, the second exam is now here. Oh my goodness, you're like, Dr. B, this is crazy. You know, we just finished first exam 2 weeks ago. Yeah, I know. So the thing that you've noticed with the pace of this course is that week 3 you had your first exam. Week 5 we have our second exam. Week 7 we have our third exam. Week 8 we have a final exam. Oh my goodness! In addition to the homework assignments and the reports and all and the project and all that good stuff, right? It's a lot. Yeah, it's a lot of work. But you have to remember, this is an 8-week course that you're learning a lot of content in. So here's my recommendation, my tip for your success this week. What I recommend that you do is participate in the discussion first. Very easy. That should be very simple for you. When you get into the content, the homework, my recommendation is take care of that homework assignment this weekend, Saturday or Sunday. Knock it out. Take care of it this weekend, Saturday or Sunday. The reason why I recommend you do the homework assignment this weekend is you have your exam. The exam needs to be completed by Tuesday night. So if you do homework assignment by Saturday or Sunday, and then you do your exam by Tuesday night, you'll be well prepared. It'll give you a few days to study. The exam 2 covers what you learned from weeks 4 and 5. Weeks 4 and 5 are covered on the exam 2. So my recommendation again is complete your homework assignment by Saturday night or Sunday. Give yourself a few days to study, and then complete exam 2 by Tuesday. And so that should give you ample time. That is my recommended approach to the exams. So if you have any questions on that, please feel free to contact me. Be happy to help you out. So as a reminder, complete your homework assignment by this weekend and exam 2 by Tuesday night. Exam 2 covers content from weeks 4 and 5. So, and I'm confident you will all do very well. Okay, let's go ahead and jump into this week's content, which is on cost behavior, cost volume profit analysis, and contribution margin. And as always, I will post this recording and the PowerPoint presentation to the discussion area. Okay, so cost volume profit analysis. What is it? You might be asking. What is cost volume profit analysis? What is cost behavior? Cost volume profit analysis is a fancy word for break even. It is the objective of every business to make a profit. How do we know when we're making a profit? Through this concept called cost volume profit analysis, or break even. We need to make and sell products, uh, and, and we need to make sure our costs are in line and our revenue is in line to make a profit. And once we pass the threshold, also known as the break even point, we can then start to make profit. Break even is where revenues equal expenses. Revenue equals expenses is break even. Yeah, there's more than that, of course. So to better understand the on the expense side from a production perspective, we need to understand cost behavior. So this part of the first part of the presentation will be a cost behavior, and then the rest will be cost volume, profit analysis, and contribution margin. So cost behavior, what is it? We must first understand what is cost behavior. Cost behavior are the associated costs with producing and selling a product. These would be as you know, to create a product, we have direct labor, direct materials, and factory overhead. We know that now, right? Direct materials, direct labor, and factory overhead make up the cost of producing a product. And as you might expect, there are activities associated with that. And we learned a little bit in the previous week about activity-based costing. Cost behaviors are associated with those activities and the activities that cause changes in those costs. I had mentioned last week that with every unit of output, there is an associated cost. As production increases, we're producing more, and therefore we are having more activity. And with more activity comes more cost. So the best way to think about this is higher activity, higher associated cost. And we'll talk more about that when we get to contribution margin. But one thing you'll learn about contribution margin is with every additional unit of input, there's an additional unit of output, right? And there are the associated costs with that. And also, when it comes to understanding cost behavior, we need to understand the range of activities over which the changes are being incurred. And the range of activities include the activities associated with the production and selling of a product. We know that the costs of producing a product include direct labor, direct materials, factory overhead. We know that factory overhead is determined or can be applied based off of single plant-wide rate, multiple department rate, or activity-based costing. And we know that there is a range of activity associated with it, and there's also related costs. We know that selling and administrative expenses through the direct method of application are also allocated to the cost of selling the product. So this is what we mean by cost behavior. There's no real science. It's more of a behavioral aspect of things. So let's talk about costs and how costs behave. Costs can be classified as being variable, fixed, or mixed. A variable cost is a cost that changes with the level of output. We know that variable costs would include things like hourly wages, electricity, direct materials. These are variable costs. Why are they variable? Because they change with the level of output. If I produce more, I need more direct labor, I need more direct materials. If I produce less, I need less of those things. Electricity or utilities, another classic example of a variable cost. These costs change based off of the changes of output. I need more electricity when I produce more because I'm running the machines longer. And the opposite is also true. So that's variable costs. Then we have fixed costs. Fixed costs are costs that do not change over time. Okay, they might change slightly over time, but for the most part, they're fixed. Fixed costs, they do not change over time. This would include things like rent, mortgage, salaries, you name it, right? There's not a lot of them, but fixed costs are costs that do not change over time. They might change slightly from year to year, but they'll be consistent for at least 12 months. Consistent for at least 12 months is a characteristic of a fixed cost. It does not change over long periods of time. Those are fixed costs. Again, rent, mortgage, car payment, that type of thing. Those are fixed costs. They do not change month to month. They stay the same consistently for at least 12 months or more. Salaries, another example of fixed costs. Then we have these things called mixed cost. Mixed cost. Mixed cost is a combination of fixed and variable costs. An example of a mixed cost would be rent that is tied to the level of output. What do I mean by that? In a retail setting, let's say you're a store owner at a shopping mall. Okay, you're a store owner at a shopping mall, and you have what we call variable rent. Okay, variable rent. It's a fixed based rent that you pay monthly, but you also pay a percentage of sales in addition to the base rent. In that case, that is what we call a mixed cost. Okay. The idea behind it is there is some portion that is fixed and some portion that is variable. And with a variable rent in a shopping mall, stores and shopping malls pay a base rent, but they also pay a percentage of sales in addition to their rent to the mall owner. And that's how malls work, right? And so that is what we call a mixed cost. It's probably the best example I have. That's as clear as can be, right? Okay, so to recap, variable costs are costs that change based off the level of output, or what we call changes in base of activity. When the activity base and units produced, direct materials, direct labor are normally classified as variable costs. As I said earlier, for every additional unit of output, I have additional direct materials and direct labor to produce that additional unit, right? And so that's why we classify direct materials and direct labor as variable costs in production, because as production levels change, so does the direct materials and direct labor used. A couple of examples of in variable costing. For universities, this is an interesting concept. For universities, for faculty who are part-time, the university associated cost is the instructor's salary or their hourly wage. And then we have the number of classes that is tied to the instructor's salary. Another great example. Oh, this one's probably my favorite because it makes the most sense. Passenger airline, your Delta, United, JetBlue, so forth and so on. Passenger airlines. The largest cost associated with running an airline is fuel. Fuel is a variable cost because it's directly tied to the number of miles flown. Manufacturing, in manufacturing, we have direct materials that are associated with the number of units produced. In a hospital, the largest cost is nurses' wages, and that their wages are tied to the number of patients. In a hotel, the housekeeping wages are tied to the number of guests. Makes sense. In a bank teller's wages is tied to the number of banking transactions. As you can see, the costs associated with each type of business are variable in this case, and they are related to their respective activities, their activity base. So that's variable costs. So just remember, just keep in mind, when it comes to variable costs, whether it be direct materials, direct labor, or utilities or things like that, these variable costs change based off of the levels of production. Go up and down based on the levels of production. Now let's talk about fixed costs. Fixed costs, as I mentioned before, are costs that remain the same over time, regardless of the changes in activity. So for example, I still have to pay the factory rent as being the same amount, regardless of the number of units I'm producing in the factory. I can produce 1,000 units, but my rent's still the same. It doesn't matter. If I produced 1,000 units, 500 units, or 0 units, I still have to pay rent. Rent is a fixed cost in this example. When the units of activity change, the factory overhead costs, such as straight line depreciation, remain the same. We talked a little bit about depreciation. Depreciation, as you know, is how the fixed assets, like property, plant, and equipment, lose their usefulness over time. And that usefulness is expensed through this process called depreciation. Depreciation is typically the same over time, right? So you can classify depreciation as being a fixed cost. Fixed costs do not change over time, regardless of activity level. They are always the same, typically, right? So using the same examples, a university, passenger airline, manufacturing, hospital, hotel, bank, we have fixed costs. There's always fixed costs, right? In the university, it's the building. The buildings are a fixed cost. They pay the same mortgage or rent, and they depreciate the same way. For an airline, it's the airplane itself. The airplane itself, they have to pay the same monthly lease or finance for the airplane itself. They also have to pay the same depreciation amount every year. And it's, again, regardless of the changes in activity, these are fixed costs. In a manufacturing plant, it's a plant manager's salary that does not get directly tied to production, right? In a hospital, it's the property insurance for the property of the hospital. It's the same every year or every month. For a hotel, it's the property taxes. They still have to pay the same property taxes regardless of the number of guests that stay at the hotel. And for a bank, it's the bank manager's salary. It doesn't change over time, regardless of the number of customer accounts. So what about mixed costs? Mixed costs, as I had mentioned earlier, is a combination of variable and fixed costs together. We call these mixed costs. Sometimes we call them semi-variable or semi-fixed. It's all the same. Mixed cost is the same term for mixed cost. You can use semi-variable or semi-fixed. Either way, when you see the word semi, it means partially, right? So a mixed cost is a combination of both fixed and variable costs. As I mentioned earlier in my example for rent in a shopping mall, the rent in a shopping mall has a base rate plus a percentage of sales. And that's what makes that rent for a shopping mall a mixed cost. So, of course, there are effects in changing activity levels. As I had said earlier, as level of production increases or decreases, the total variable cost will change based off the level of production because it's variable. It changes with the level of output. But when it comes to per unit amount, it remains the same. For fixed costs, the total amount remains the same regardless of the activity level. But this also means that the per unit cost changes. Okay, so let's look at all the variable, fixed, and mixed costs together in a comparison. Variable costs include things like direct materials, direct labor, utilities, and supplies. Fixed costs include things like straight line depreciation, property taxes, supervisor salaries, and insurance expenses. They're fixed. They remain the same regardless of level of output. And mixed costs include examples would include things like quality control department salaries. The reason why that's a mixed cost is because the wages, the hourly wages are fixed, but might change depending on the number of quality control inspections. Mixed costs also include things like purchasing department salaries. There's usually a base rate, and then there might be a plus overtime or things like that. Maintenance expenses, oh, that's for sure. Maintenance expenses are not routine in most cases. They are performed based off of output, right? So oftentimes the maintenance will have a base salary, but there will be changes in the related expenses depending on the level of output. And warehouse expenses, another example of mixed costs, because the amount of warehouse expenses is tied to, you have your base rent for the warehouse, but you may also have a variable component based off of the supplies being used in the warehouse. Okay, are there any questions so far as it related to the cost, the cost behaviors for variable, fixed, mixed? Did all that make sense?
Yep, it did.
Fantastic. Thank you, Melinda. I appreciate the affirmation. Okay, now let's jump into one of my favorite topics, cost, volume, profit analysis. Oh, I get so giddy every time I hear the word profit. I always get very, very excited. I love profit. Who doesn't love profit? That's why we're in business, right? That's why every business exists. Even if it's a non-profit organization, guess what? They still make a profit. We just call it something else. Still a profit, though. Okay. Cost, volume, profit analysis. In this examination of cost volume profit analysis, we are looking for what we call the point of break even. And we're looking for the relationships between revenue, expenses, costs, and profits. Okay. So in cost volume profit analysis, we analyze our strategies for making profit, we set selling prices, we select the product mix, and we choose among marketing strategies. These are all very standard business practices. Any business that is in the business of selling something, whether it be a retailer or a manufacturer, need to understand their business when it comes to a perspective of cost and their strategies. Okay, so here's how it works. The business creates a product and it looks to sell that product. Okay, let's say it's a calculator. Let's say we're in the business of making these calculators, like the one I have in my hand here, Texas Instrument BA2 Plus. Okay, so this calculator that I have here, let's say we're Texas Instruments, okay, and our business is to develop, produce, and sell these calculators. And I need to understand what are the costs associated with making this calculator. Well, I have direct materials, obviously. I have plastic. I have some electrical components, and those are the majority of the cost for direct materials. Probably a semiconductor, right? And then we also have some labor. It probably takes maybe about a couple of minutes to put one of these together. And then I also have some overhead, factory overhead, that needs to go into this calculator. So altogether, we'll say it takes maybe about $10 to create this calculator. Okay, that might be on the high side even. So $10 to create this calculator. That's my direct materials, direct labor, factory overhead to create one calculator. $10 total. It's probably like, $6 or $7 of direct materials and $3 of $2 of labor and $1 factory overhead. Okay. So I have a $10 cost. Now I need to understand my business. I made the calculators. Who am I selling them to? I figure out who my customers are. And I do that by selecting a marketing strategy. How am I going to sell these things? I'm going to sell these to professors who teach accounting and finance. Great. Okay, so I know my target audience. Great. So what do? Well, I'm going to publish some ads in some magazines that those people read. Great. And so we do that. That's our marketing strategy. That obviously there's a cost associated with that strategy. And our company, we don't just make this one type of calculator. We have a whole bunch of different types. So that's our product mix. And we have to set the selling prices. The sales price for this calculator it cost me $10 to make it, so I'm going to sell it for $100. That's probably exactly how much they sell these things for, right? So my desired margin, my desired profit for each calculator is $90. Okay. So if my desired so it cost me 10 to make it, I want to sell it for 100, desired profit's 90. So as I analyze these costs and my desired profit, things like that, I take into consideration changes in selling prices on and what the impact is on profits, the effects of changes in cost on profits, and the effects of changes in volume on profits. So ways to think about it. The more calculators I sell at $100, it costs me 10, the more profit I'm going to make, right? That's the volume. The more I make these calculators, my cost will eventually go down a little bit because I'm producing in mass and volume. The less I make and the less I sell, the more it costs me, so my profits will go down. And the selling prices, if I decide to take this down from $100 down to 90, then clearly my profit will drop down to 80. So these are all things we analyze as we're setting prices. So I know we covered a little bit there in some details. I want to talk to you a lot about contribution margin because this is where profit comes from. Okay. This is like the most important part of business. Okay, contribution margin is the excess of sales over variable costs. Okay, the very simple formula here is sales minus variable costs. Now, you might be asking, Dr. B, what goes into variable costs? We already talked about that, but we'll talk about it a little bit more. Variable costs include direct materials, direct labor, and other associated variable costs. Okay. So sales minus direct materials, direct labor, other variable costs equals contribution margin. The contribution margin covers fixed costs. Because as you know, there's other costs associated with running business. It's not just variable costs. So the contribution margin will cover the fixed costs. Once the fixed costs are covered, any additional contribution margin increases operating income, also known as profit. Okay. So the best way to think about contribution margin is you have your revenue, your sales minus your cost of goods sold equals gross profit, and then you have minus your operating expenses equals net income. You know that. You know that from looking at the income statement, right? But what you need to identify is that once you get to your sales, instead of just simply subtracting out cost of goods sold, we're subtracting out your variable costs, direct materials, direct labor, and other variable costs, right? Now, as you would expect, with pretty much everything else we do in accounting, there's going to be some ratios. Understanding this ratio will help you as a manager to understand the level of profitability for the company. We call this a contribution margin ratio. It's also called the profit volume ratio, but typically you'll always hear it called the contribution margin ratio. It tells us the percentage of each sales dollar available for covering fixed costs to provide operating income. The formula is very straightforward. You take your contribution margin divided by sales. As a reminder, contribution margin is calculated by taking sales minus variable cost. So sales minus variable cost divided by sales gives you your contribution margin ratio. So sales minus variable cost divided by sales is your contribution margin ratio. So I have a short example here. We have a company that has a contribution margin of $400,000 and sales of $1 million. The contribution margin was found by taking the sales minus variable costs to get to the 400,000 divided by sales, which was $1 million, equals 40%. 40% in this example is the contribution margin ratio. Now you might say, oh, Dr. B, is that good? You might be asking, is that good? Is it good? Good is a relative term, right? Is it good? Yes, it's good. Why is it good? It's above one, which means they're making profit. Is it good? Well, this tells me they're making about 40% profit in their business for this time frame. So yeah, it's good. It's good. Remember, good's relative. Okay. So there's more. There's more. The contribution margin ratio is most useful when there's an increase or decrease in sales volume because it's measured in sales dollars. So as you might expect, the contribution margin ratio is going to fluctuate based off of the amount of sales in that given time frame. In this case, the change in sales dollars multiplied by the contribution margin ratio will equal the change in operating income. It's good to understand the change in operating income from accounting period to accounting period to understand the company's profitability, their ability to be profitable. So the change in operating income, very straightforward formula. It's the change in sales dollars times the contribution margin ratio. Dr. B, how do you find change in sales dollars? Well, you take your newest sales dollars amount minus the old sales dollars amount, right? That's how that's your change in sales dollars. And we multiply that by the contribution margin ratio. How do you find contribution margin ratio? You take your contribution margin divided by sales. And remember, contribution margin is sales minus variable cost. So sales minus variable cost divided by sales. So change in sales dollars times sales minus variable cost divided by sales. It's the best way to extrapolate this formula. Kristen, did you have a question?
Yeah, sorry. So on the contribution margin ratio equation, in the textbook, it's saying that it's contribution margin over sales per unit, or is it sales total?
It's sales total.
Okay.
Well, it's good question. Okay, so let's break that out a little bit further, and that's an excellent observation. You can, and Briston, this is the best way I can explain it to you, is this contribution margin ratio is for the whole company. The contribution margin ratio can also be used on a per item basis. So you can break down the contribution margin ratio on what we call a micro scale, right? So you can figure out contribution margin ratio per unit, which is what you're talking about. Or you can also figure out contribution margin ratio for the whole company, which is what we're talking about here. So in other words, Briston, you can use the contribution margin ratio from a company perspective or from a product perspective. Does that help to answer your question?
Yes, that does. Thank you, Professor.
Thank you. I appreciate you asking the question. Very good question. Okay, so the change in operating income is calculated by taking this change in sales dollars times the contribution margin ratio. In our example, our company from earlier, we added $80,000 in sales from the sale of an additional 4,000 units, which is an operating income increase by 32,000. Okay, so we got 32,000 as our change in operating income. How do we get that change in operating income, you might ask? You take your change in sales dollars. In this case, we added 80,000, so we're up 80,000 times the 40%. How did we get 40%? 40% is our contribution margin ratio. So 80,000 times the 40% equals $32,000 of change in operating income. So let's, and this actually plays right into Bristen's earlier question. Let's talk about the unit contribution margin. Unit contribution margin. The unit contribution margin is useful for identifying the profit potential for proposed decisions. What does that mean? So if a company is making a decision to sell a particular product, we can identify what the potential profit will be on the sale of each individual product by looking at what we call the unit contribution margin. The unit contribution margin is calculated by taking the sales price per unit minus the variable cost per unit. So if our company is selling each product at $20 per unit, and we have a variable cost of $12 per unit, that gives us a unit contribution margin of $8. That means I will earn a potential profit of $8 for every unit that I sell. How do we get the $12 of variable cost, you might be asking? Well, it's probably, I'm just making this up, right? We'll say it's $8 of direct materials, $2 of labor, and another $2 of variable costs. Okay, and so that gets us the $12. So you take your sales price minus the variable cost per unit equals your contribution margin. In this example, $8. So we're making $8 of profit for potentially for every unit that we sell. The contribution margin is very, very powerful when it and most useful when it comes to the increase or decrease in sales volume. Now, of course, as you might expect, the more I sell, the more potential profit we have to make, right? You know, if I'm making a profit of $8 per unit, in this example, if I sell 15,000 more units, that gives us an additional potential profit of 120,000. So, in other words, the change in the quantity that I'm selling will result in either an increase or decrease in the potential profit. In this case, the change in the sales volume is multiplied by the unit contribution margin, which gives you the change in operating income. So change in operating income, we take the change in sales units times the unit contribution margin. In our example, we know that the unit contribution margin is $8 per unit. That's $8 of potential profit per unit, right? The change in sales dollars, in our example, we recognize that our company sold an additional 15,000 units. We went from 50 to 65. Okay, that looks like we had a good month, right? We sold an extra 15,000 units this month. Awesome, cool. So how do we calculate the change in operating income? We take the 15,000 units, which is the difference between 65 and 15. So 15 is the difference between 65 and 15. How do we know? Take 65,000 minus 50,000 equals 15,000 units. So 15,000 units times the unit contribution margin, which is $8, gets us a change in operating income of 120,000. It's pretty good. Yeah, I like it. Yeah, you know, nothing wrong with a little extra profit. Any questions on contribution margin before we jump into another wonderful topic called break-even? We're good? Okay. Wonderful. Okay, let's jump into break-even. Break-even is the point where revenues equal expenses. Very, very simple. Very simple concept. Break-even is the point where revenue equals expenses. Companies cover, we're making just enough money, just enough revenue from our sales to cover all of our operating expenses. That's good. That's good. Yes, it's good to break even. It's even better to make a profit. The point of break even is where we're not operating at an income, but we're also not operating at a loss. This is where net income equals zero, right? When net income equals zero, that means we've broken even. Okay, that means break even. We don't have income, we don't have a loss. That's break even. Net income equals zero is break even. Okay, how do we find, and we're going to talk about break even from a perspective of sales in both dollars and units. How do we find break even? What is the formula for break even? Let's look at it from a perspective of units. In other words, how many units do I need to sell in order to break even? Oh, that's a great question. I get that question a lot from small business owners. They'll ask, oh, Dr. B, I'm having trouble trying to understand how many units do I need to sell to make money? And so, obviously I go a little bit deeper than just this formula, but I usually tell them, I'll ask them, have you calculated your break even for sales in terms of units? They said, well, no. So, it's very simple. All you need to do is take your fixed costs and you divide your fixed cost by the unit contribution margin. And that will give you your break even in terms of units. Break even in terms of units. So fixed cost divided by unit contribution margin. We know unit contribution margin is sales price per unit minus variable cost. So fixed cost divided by sales price minus variable cost. Nice visual representation. Where when revenue equal your costs, you have reached break even. So that's units. Okay. What about dollars? Now the owner knows how to break even in terms of units, because they asked Dr. B, how many units do I need to sell in order to break even? And we said, take fixed cost divided by unit contribution margin. Now they come back and say, okay, well, now I got that part, but how much revenue do I need to make? How much revenue do I need to make in order to break even? Excellent question. To figure that out, we calculate the break even in terms of sales dollars. So to figure that out, we take our fixed costs divided by the fixed cost divided by the contribution margin ratio. Contribution margin ratio for the company, not for the product, right? So fixed cost divided by the contribution margin ratio. That tells you how much revenue you need to earn in order to break even. That's the beautiful thing with break even. We can look at it in terms of units and dollars. We could even go as far to say, we could even go as far as to look at the ratio, right? Contribution margin ratio. The contribution margin ratio is computed by taking the unit contribution margin divided by the unit selling price. So unit contribution margin divided by unit selling price. In our earlier example, we have a unit contribution margin of $8 per unit, okay, divided by the selling price. What did we say the selling price was? I think it was like $20, right? Yeah, $20. So you take the let's do it real quick. So we have $8 unit contribution margin divided by $20. 8 divided by 20 gets us to 40%. 40% contribution margin ratio. Okay. Let's talk about changes. What happens when our costs change? Fixed costs, as you know, do not change with the level of activity. However, fixed costs may change because of other factors, like advertising campaigns, changes in property tax rates, changes in supervisor salaries. Just like I said earlier, typically, fixed costs do not change. They may change after a 12-month period. An example, you got a raise. You're on salary and you got a raise. Clearly, that's going to increase the fixed cost. Or the property tax rate went up for next year. So next year, our fixed cost will increase. So forth and so on. Once in a while, it changes. This means there will, of course, need to be a change in the break-even point. The break-even point will increase or decrease based on the change in the fixed cost. So if fixed costs increase, we need to increase the break-even point. If fixed costs decrease, we need to decrease the break-even point. Makes sense, right? They run in parallel to each other. Increase in fixed costs means increase in break-even point. Decrease in fixed costs means decrease in break-even point. Very straightforward. Increase fixed cost, increase break-even. Decrease fixed cost, decrease break-even. They run together. Fixed cost and break-even, as they rise and as they fall, so does the point of break-even. What about variable costs? Variable costs, unit variable costs do not change with the level of activity. However, unit variable costs will be affected by other factors like the change in direct materials, the change in direct labor, the change in sales commissions. These factors will change the variable cost. So if the cost of my direct materials increases, that means my variable cost needs to increase by that same change. Same with direct labor. If my direct labor increases, that means my variable costs have increased. What is the effect on break even when there's a change in variable costs? So just like fixed costs, as the variable costs per unit increase, so does the point of break even. And as they decrease, so does the point of break even. Again, we see a parallel between the relationship between unit variable cost and break even cost. As unit variable costs increase, so does break even. And the opposite is also true. So that's the relationship between fixed and variable cost. As fixed cost or variable cost increase, so does the point of break even. And the opposite is also true. Now, what if there's a change in the selling price? Okay. So let's say I'm selling let's say they're basketballs or volleyballs or something like that, okay? I'm selling my volleyball for $20 a unit. And my contribution margin is $8. Let's say, I think I should raise the price of my volleyballs because volleyball has become very popular now. And I know I can squeeze a little bit more out there. So let's raise it to, let's raise my selling price to $21 for volleyball. Well, the variable cost is still the same. It still cost me $12 to make them. But that also means that my contribution margin increased by $1. So I went from $20 to $21 selling price. My variable cost remained the same at $12. My contribution margin went from $8 to $9 per unit. Well, when there's a change in the sales price, there is a change in break even, and it's inverse relationship. As I increase the sales price, the point of break even decreases. Okay, if I raise my prices, I could get away with selling less. Yeah, you see that? As I raise my prices, I can get away with selling less, right? Because I'm making more profit, and I don't need to sell as much, right, to get that profit. If I raise things by $1, I don't need to sell that additional unit, right? The opposite is also true. If I decrease the sales price of my volleyball from $20 to $19, that means I have also decreased my contribution margin by $1. And with that decrease in contribution margin, that means I need to sell more to break even. Does it make sense? Any questions so far? Oh, good. Okay. So remember, when there's a change in fixed and or variable costs, the break even goes in the same direction. But when there is a change in the selling price, the break even has an inverse relationship. And here's a nice representation of that. Fixed and variable costs, as they go up, so does break even. As they go down, so does break even. The only difference here is in the selling price. When the selling price goes up, my break even goes down. When the selling price goes down, my break even goes up. And that's how business works. Yay. Earlier I mentioned the word target profit. You heard me say that. You heard me say the word target profit. This is where going back to my calculator example. I said earlier, let's say we're Texas Instruments. It cost me $10 to make this calculator. And I want to sell this calculator for $100. That means my target profit is $90. I want to make $90 on this thing, okay? I want to make $90 on this thing. So to figure out target profit, this is where the sales required to earn a target or desired amount of profit is determined by modifying the break-even equation. How many of these things do I need to sell, okay, to break even? So if my fixed cost, I take my fixed cost plus the target profit divided by the contribution margin. Now in my example, my calculator example, okay, I said my target profit is $90, and my I said my target profit is $90, and I also said my unit contribution margin is $90, right? So I sell for 100, my unit contribution margin 90. Fixed costs are the fixed costs associated, I believe I said were $2, right? So 2 plus 90 divided by 90. Let's see, where's my calculator? 2 plus 90 divided by, which is 92 divided by 90, equals 1.02, so 102%. Or I need to sell 1 unit, or 1.02 units. So yeah, that's an interesting way of modifying the break-even point in order to generate the target profit. Remember, target profit, how much you want to make. Okay, this is a nice little chart, kind of shows us the cost, volume, profit analysis from any graphical representation. In order to understand cost, volume, profit, I need to consider my sales price, my costs, and my my associated profit or loss. And we could see all that information on a nice chart. That's what that is. A couple of steps with creating this chart, and you don't really need to know this, it's just kind of nice to know. The steps with creating the chart or analyzing the chart is the first step is we look at the volume of sales along the horizontal axis. We draw the relevant range and the dollars associated with that on the vertical axis. Second step is we look at the total sales line plotted by connecting the lines at 0 to the left of the corner and then go up from there. It's just kind of a graphical representation. Step 3 is we look at the total cost line plotted along that. And step 4, we look at the break-even point where the sales and cost lines intersect. There's another thing called a profit volume chart. This is another graphical representation of cost volume analysis. And the plot shows us the difference between the sales and total costs. Remember, break even is a point where revenue equals expenses. And anything above break even we consider to be profit. Nice visual in your mind to think about it. And here are the steps to producing that chart. I'm not going to bore you with this stuff. Okay. That's why I'm not even bothering to show you the charts. I just want you to understand that these charts exist. The textbook does an okay job of showing that, but it's, you don't have to worry so much about. I'm not going to ask you to draw graphs or anything like that. That's not this kind of class. The idea behind showing you this is I want you to understand that these charts exist, and we look at these just as a quick reference to understand how to analyze cost, volume, profit. So there's a couple of assumptions that we need to take into consideration when we analyze cost, volume, profit. We take into consideration the total sales and total costs represented by straight lines. We take into consideration the relevant range of activity, and we also know that fixed costs do not change. We take into consideration fixed and variable components. We look at the sales mix as being constant, and that there is no change in inventory quantities during the period, although we know that does happen. But in order to understand cost, volume, profit analysis, we need to make sure that these things are constant in order to analyze that information. Earlier, I talked about this thing called sales mix. This is more of a marketing concept, but it's important that we as accountants understand it because this helps us to better understand our sales revenue. Many companies sell more than one product. Oh, what a shock. And they're even at different selling prices. Oh, I had no idea. In addition to the products normally have different unit variable costs. And of course, if there's different variable costs, that means there's going to be different contribution margins, just like we talked about earlier in the volleyball example. In these cases, break-even analysis can still be performed considering what we call the sales mix, which is a relative distribution of sales among products sold by the company. For break-even, we take into consideration the individual products, the companies as components of an overall enterprise product. The sales price of the product equals the sum of unit selling prices of each product multiplied by its mix percentage. In other words, what do we do here? We add up all of the sales prices for each product that the company sells, and we multiply that. We take that sum and we multiply that by the sales mix percentage. How do you get sales mix percentage? You might be asking. Sales mix percentage, we find that by taking the sales figures from each product and dividing that by total sales. That gives us our sales mix percentage. Unit variable cost and unit contribution margin of the company product equals the sum of the unit variable cost and unit contribution margins. In other words, this is a nice way of applying break even to a company that sells multiple products. Good news is you don't have to worry too much about that. It's just good to know. Operating leverage. This is important to know. This is very important to know. Operating leverage. This operating leverage is it tells us the company's ability to utilize its contribution margin to generate profit. Okay. To calculate operating leverage, we take the contribution margin divided by operating income. So to find operating leverage, contribution margin minus operating income equals fixed costs. Fixed costs tell us that companies with high fixed costs have a higher operating leverage. Operating leverage, it's important to know, especially when it comes to identifying the impact of changes in sales on operating income. Using operating leverage is the effect of changes in the sales on operating income. How do we compute it? To calculate the percent change in operating income, we take the percent change in sales times operating leverage. How do we get percent change in sales? New sales minus old sales divided by sales. Companies with high operating leverage typically also have a large percent of change in sales dollars. And the opposite is also true. Okay. Let's talk about another topic real quick. And we're almost done. Margin of safety. This is a good one. A lot of this stuff that we're teaching you today, or I'm teaching you today, you'll find in both accounting and in finance in some cases, especially when it comes to analyzing financial information. Margin of safety. This indicates a possible decrease in sales that may occur before operating in a loss. That's why we call it margin of safety. It's basically like an indicator that goes off and it says, hey, there's a potential problem here. Your sales dollars are decreasing. It's like a red flag that goes up, right? And it tells you, hey, we're losing sales dollars as a comparison of the previous accounting period. And we need to warn you before it becomes a loss. So the operating margin of safety is low, even as a small decline in sales revenue results in an operating loss. Operating loss is the worst thing ever. Okay, so what is margin of safety? How do we express it? Margin of safety can be expressed in terms of dollars of sales, units of sales, percentage of current sales. To be expressed as a percentage of current sales, we take the sales minus the sales at the break-even point. This second part here, that's not a minus sign. That's that little guy there. That's just break even. Yeah, break even. Break even is hyphenated. Okay. So it's sales minus sales at the break even point divided by sales. That gives us our margin of safety. Remember, sales, you'll be able to find that on your income statement. That's your revenue. Yeah. Oh, sorry, apologies. I went a little too fast. Almost done. Cost volume profit analysis for service companies. As I had mentioned before, this course we focus a lot of our attention on companies that sell products and produce products because we talk a lot about cost. The same concept of break even can be applied to service companies. The primary difference between a production or a retailer and a service company is that with a production company or a retailer, we take into consideration things like direct materials, direct labor, factory overhead, fixed and variable costs. Whereas with a service company, we're more focused on the fixed and variable costs. Okay. The service or the revenue that comes from service companies are allocated to customer activities or service activities, right? These would be like patients, attorneys, clients, accountant clients. Those are your sources of revenue. And we look at each client as the product. Yeah? That's a way of thinking about it. Okay, that is the end of our presentation for the concepts covering contribution margin and cost volume profit analysis. Are there any questions that you would hope that I would have covered? Any questions, comments, concerns, anything at all?
No, thank you, Professor.
Great. Thank you, Briston. I appreciate that. And as always, if you do have a question and it comes up later and you're like, oh, I should have asked that, or oh, I thought about that after listening to the presentation and reading the text. If you think of anything, just let me know. Feel free to ask it in the discussion forum. A lot of times your classmates have the same question. Or please feel free to just simply call me or email me or set up office hours or whatever you prefer. And then Melinda, are you okay? Do you have any comments, questions, concerns?
I think I'm good. I think I haven't done any of the reading yet, so I think I need to do some of the reading and I might come up with some questions, but I think I'm good from your presentation today. Thank you.
Perfect. Wonderful, wonderful, wonderful. Well, I appreciate both of you spending some time with me and hanging out with me. And I hope you enjoyed the session. I hope you got a little something out of it. If anything, at least you got some context out of what to expect for this week. Now, please make sure that as you are going through the readings, after going through this presentation, go through the readings, and then go ahead and give that homework a try. And take your time on it. There's no rush, but as I had mentioned earlier, when we started, the plan of attack for this week is your discussion. That should be pretty straightforward. It's discussing the statement of cash flows from your 10K project. And then, of course, go through the readings. You want to just go through the line, right? Your homework 5, try to take care of that this weekend. The reason for that is because we also have the exam 2. The exam 2 will cover content from last week and from this week. And that's why it's very important that you do the homework 5 before attempting exam 2. And then you'll wrap up with your standard weekly report out, which I find very helpful, actually. I read those and I respond to your questions and I respond to your feedback and your experiences that way. And I find it helpful because I take your feedback very seriously and I also adjust my approach based off of that feedback. So hearing or seeing no other questions, I would love to call this a wonderful meeting. And if you think of anything afterward, please, again, feel free to ask questions in the discussion forum or email me or call me or whatever you feel comfortable with. And thank you again so much for your time. And I wish you all a wonderful rest of your day or evening, wherever you may be. And please continue to wash your hands and stay safe and all that great stuff. So
Thank you, Dr.
so
B.
much. Thank you, Melinda. I appreciate you. Thank you, Briston. I appreciate you being here as well. So thank you both so much, and enjoy the rest of your time.
You too.
Thank you so much. Bye-bye.